Good afternoon and welcome this afternoon to Market and Sector Analysis, another great webcast from Schwab Coaching. We're wrapping up a really interesting week here in the market. And I know I always say that, but this has been, I think, perhaps even more so. Well, I always say that too, so I don't know if I can actually say that it has been more interesting. Every week is interesting in the market when you are here and when things are going on. So welcome to all of you. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. So I'm glad to have you all with me. Thank you for being here. My good friend Cameron May is out there in the chat to help answer questions along the way. So we'll take a look at what's going on, what has gone on, and what might go on next week in the market. If you're here with us live, leave us or be part of the conversation, be part of the chat. Cameron is going to be there to help facilitate that. If you are watching this in the recorded version, we're glad to have you do that and be a part of the conversation there as well. Leave us a comment in the comment section. Now, as we get into this discussion today, let's talk about a couple of quick housekeeping items first. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. Remember that Schwab doesn't recommend these technical analysis as sole means of investment research. If we happen to incidentally talk about options content in this discussion, remember that options are leveraged products. They entail substantial risk. Make sure that you understand that they are not suitable for all investors. And make sure that you read and understand the characteristics and risks of standardized options before considering any option strategy. We're going to be using the Thinkorswim desktop software platform today for this discussion. Again, we're going to be using the paper money version of that. That's not a guarantee of future success out there in the real world. It's a great learning environment, however. Make sure you understand that there are some differences between a paper money platform and a live trading platform that you need to pay attention to as you move from one to the other. Also, remember that investing involves risk, including the risk of, in some products, more than your initial investment. Now, speaking of that, if we happen to talk about futures or futures products in this discussion, we are talking about those simply as market instruments or market measurements, not as tradable products. We have a webcast that talks about those products as tradable products or tradable instruments. That's on Tuesday mornings. I teach that webcast. It's called Trading Futures. And I'll get you the link for that as well. But just remember, if we discuss futures in today's conversation, that is for illustrative and educational and market definition purposes only. Also, remember that any third-party information that we happen to see or discuss in this context is the opinion of those third parties that provide that information. So once again, thank you for joining me. And let's jump out and see what is going on. Here we are on Friday. It is Halloween Friday, which, is maybe spooky for some people, but not necessarily spooky for the market. At least when we put spooky into some kind of context, and we'll talk about spooky here in just a minute. But the SPX, post the FOMC meeting this week, which brought us 25% rate cut to the front end. We'll see what it's done perhaps to the 10-year, if anything, going into this discussion. But that was perhaps not the biggest news. The bigger news was what followed beyond that. And this was maybe a little bit more of that buy the rumor, sell the news type of perspective from the standpoint of this was a widely anticipated cut. But the bigger story perhaps was really two things. One was the fact that Fed Chair Jerome Powell said, hey, this is not a foregone conclusion that we're going to get another cut in December, which was kind of on the table, kind of part of the discussion. He said that things have gradually cooled, policy is meaningfully less tight, and it is calibrated to avoid further deterioration in the employment situation without impacting inflation. And so at the same time, we get a week where some of the major, especially in the technology space, have announced significant layoffs. Amazon, Apple, and others, Microsoft, indicating that they are laying off employees and substantial numbers of employees. The other maybe argument coming out of the Fed discussion is the fact that they've changed their balance sheet, and it's going to end on December 1st, the process of quantitative tightening or really kind of rolling off that Fed balance sheet and kind of holding their portfolio roughly steady at the moment. So net result of that essentially is that the December rate cut is not a foregone conclusion at this particular point. And it will be, as it always is from the Fed, data dependent. But what we're seeing in the SPX is in this last week, run, and then kind of pull back. And it's kind of sitting here. Now, granted, look, it's sitting at these highs or very, very near these highs underneath this 7,000. I think that becomes kind of the next Rubicon for the market to cross, is up to this 7,000 mark. Yeah, Scott says, well, why can't Jay Powell ever stick to the script? And, you know, he writes his own script, apparently. 7,000, perhaps the next Rubicon for the market, and the next big number that everybody's going to issue hats and banners of SPX 7,000. Remember where you were when it hit 7,000. We go back and we look and see where we were over the course of this last year when it hit and crossed the 6,000 milestone. So we were back here in this time frame, right, when it popped above the 6,000 milestone and then came right back down. You can see that it acted as, that whole area acted as a level of support and resistance, and it oscillated around that big round number. And I think arguably there's probably a tendency for the market to oscillate around these big round numbers simply because that's a comforting, from a psychological standpoint, a comforting number. And it may very well be that that's a magnet for upward price movement, and then we see more of a pause. Although we are seeing a little bit of a bull flag, as some of you pointed out, as Invo says, that was BJ that said bull fleeg, as James Boyd pronounces it, and that then started the great flag battle between Barb Armstrong and James Boyd with Canadian flags. If none of you have seen that post, check out James Boyd's X feed, his formerly known as Twitter X feed, as well as Barb Armstrong's X feed, where Barb pranks James by planting lots of Canadian flags on his lawn and his front porch. But we see that kind of bull flag type of movement building itself up here. Now, bull flag with a gap up and sell off is perhaps a bit of a weak bull flag and not really a lot of momentum behind this. The RSI is going up, but it's kind of also going sideways a little bit. The NASDAQ, on the other hand, kind of taking a look at the market, has maybe a little bit more defined bull flag, staying a little bit higher on this high side, on the little bit of a bounce side here. RSI moving higher, pulling back a little bit, but still maintaining those higher lows. Thanks, Janelle. I appreciate that. So we got that little bit of a higher low there. And then the kind of maybe the rubber match indicator here, and that is the Russell 2000. So if the Russell 2000 is starting to bounce here, maybe a little bit more of a risk on type of scenario. I know Kevin and James talked a little bit about it this morning in the Trader Talks in today's market webcast, which was not recorded because it focuses on ETFs, but starting to once again maybe see this little bit of a bounce. And this is maybe a little bit more bullish than the other two, just from the standpoint that we've had kind of this oscillation. Rally up, pull back to a higher low, rally up to a slightly equal, maybe slightly higher high, pull back to a higher low. So this is getting wound into this little bit of an ascending triangle here. And I would argue that maybe we've got another leg higher. That puts this index up, not really near any of those big round numbers, but you notice that 2,500 is kind of right in the crosshairs here. And 2,500 has been a resistance level previously in this range. So this may have a hard time, the small caps moving higher. Now, arguably, we would think that the small caps perhaps would be the bigger recipient of the changes from the Federal Reserve. And that sounds really good in a soundbite or in a social media post or whatever. But the reality of the situation is that when we get interest rate cuts by the Fed, that takes a while perhaps to trickle to the probably biggest impact to the small caps, which is the 10-year yield. The 10-year yield being the one that determines a lot of small business borrowing costs, a lot of residential borrowing costs. Not that that necessarily impacts the small caps directly, but it does from the standpoint that the regional banks make up a large component of the Russell 2000, as do some of the auto lenders, which also sit with a lot of those regional banks. So that's kind of where that comes home to impact. Speaking of impact, you can have a huge amount of impact on this webcast by filling out that feedback survey that just popped up in the chat. Cameron's going to post that up or pin that up to the top of the page so that you can get to that again. It's really two numerical questions and then an open field. And you guys know what to do with that by now. And if you've been with this a long time, you know how impactful that can be, and being able to fill out and provide your feedback on these webcasts. If you're brand new to these, understand we read those, we use those in shaping these webcasts on an ongoing basis. All right, so that's the index picture across the board. I wanted to just do this really quickly with this index specifically, and that is this. I wanted to pop over here to the Flask icon, and I want to type in here the word comparison. Comparison, if I start typing the word comparison, gets me to this study, comparison. And what I'm going to do is I'm going to click on the gear icon, and I'm going to go right over here, and I'm going to put in TNX colon CGI, which is the way that we get the SIBO 10-year note. This is the interest rate. There's another way to look at this as well, but this is an index, not a tradable instrument. The index itself is going to be reflective of the inverse of the bond price. Now, we could also look at the futures contract. The /10Y futures contract also gives us this same information, but it's a tradable instrument, and it's subject then to its own movement up and down based on the fact that it is a tradable instrument. So this is looking at the index. Click on OK and apply and OK. And now it's that purple line, and we see that purple line here representing the 10-year rate. And remember what we just said. I mean, we said that the Fed cut interest rates. So why today, why in the last few days, has that 10-year rate been going up? Why hasn't it been coming down by a quarter point? Well, that's because the Fed doesn't have control over this, except indirectly. The Fed changes the front end of the curve in that overnight lending rate that they charge intra-bank. That then trickles down eventually to the longer-term interest rates. And we saw a little bit of a pullback, but it's still rising. In fact, now, at the moment, if we take a look at this number right here, where that is, if we were to just simply move that decimal over on that comparison line, or on that line, we can see what that is. I mean, this is giving us a better perspective of kind of how these two relate to one another. But if we wanted to look at this directly, what I'm going to do is I'm going to pop back over here to my single grid. This is my sandbox. And we're going to look at TNX colon CGI. And there it is right there, currently at 41.01. So we just move the decimal point over to the left, 1, and that puts it at 4.10. So 4.10 is the interest rate. Now, again, Jerry makes a good point. That mortgage rates have been trending down the last month, but bond rates are up. Yeah. So even though we've been seeing, look, the 10-year's kind of been coming down a little bit, but look, over the course of this week, it started to rally back again. And one of the reasons that this changes is those banks that lend against and tie their lending rates to this 10-year note also offset lending risk by buying bonds. And so when you buy bonds, when those bond prices go up, that pushes the rate down. When they sell those bond prices go down and the yield goes, or the rate goes up. It's an inverse relationship. And so there is some back and forth here with the 10-year, and number one, and number two, and it doesn't necessarily direct exactly what those rates are to consumers, because there's always ways to buy down those rates. There's always incentives on the parts of those financial institutions. It has an impact, but it is not a direct impact. There's a reason why pundits talk about interest rates and interest rate changes as pushing on a string. If you think about that metaphor of pushing on a string, it takes a lot of pushing to get the far end of that string to change direction. And so when the Fed pushes, it takes a while for that to work its way out in the longer term. If we were to take a look at /10Y as the futures contract, you're going to see the same thing. But again, remember, this is a tradable instrument. And from that standpoint, this is subject to its own forces. But we could look kind of in the middle of this curve a little bit, because there is shorter term lending as well. /2YY is the 2-year yield. And you can see what that 2-year yield has done. It's gone up a little bit as well since the Fed rate cut. So it's taking a while. It takes a while for those forces to work their way through this yield curve. It's not a direct relationship, even though we think that it is. And that may be one of the reasons why we're seeing that segment of the Russell 2000, the regional banks, which are the primary mortgage lenders in a lot of cases, and auto loan lenders, commercial paper lenders, and in fact, a lot of aircraft lending goes on in those regional banks as well, having an impact a little bit different than what was expected coming out of the FOMC meeting. So take a look at take a look at one of those individual names, ZION, happens to be based here in Utah, where I'm from. And this is a regional bank and one of the larger of the regional banks. And we can see that on their earnings announcement, they took a big hit. That was because of that possibility of bad loan impacts, but it kind of got overdone, started to rally back a little bit. And now we start to see that on the Fed rate cut, these guys pulled back a little bit. And then now are starting to maybe digest that a little bit off of a level of support and moving back up to the upside. What I want to do real quick is I want to come over here to the Market Watch tab, to the Visualize tab, and I want to pop in here to the Russell 2000 and kind of break this down, and let's take a look at those financials. And we're going to open up those banks, and then we're going to open up those regional banks. Now, this is the view. You can see how many of them there are within this space. This is the snapshot today, but you would think that with interest rates down, remember, this is the double-edged sword of interest rates. The double-edged sword of interest rates is the fact that these regional banks, when interest rates go down, their business goes up. Basically, their traction in terms of customer lending increases because they're able to charge lower rates for products, so they become more competitive, whether it's credit card, whether it's an auto loan, whether it's home loan. But they're also making less on money under management. And so their profit stream, revenue stream from that is a little bit lower. So you can kind of see the impact to the regional banks. And this may be one of the reasons why we're seeing kind of across the board, the Russell 2000 maybe not showing as much bullishness as we saw perhaps in some of the other indexes within the space. Now, the other area within the Russell 2000, and while we're here, I wanted to talk about this. The other industry within the Russell 2000 that is also not interest rate sensitive so much, but market movement sensitive, is technology. And remember that the Russell 2000 rebalances every year. The last two rebalances in the last 2 Junes have shifted the balance of the Russell 2000 into a more similar distribution of technology stocks as at the top of the range, more similar to, say, for instance, the NASDAQ than to the S&P 500. And so this is seeing a little bit of strength, and you can see the strength coming into the information technology segment of the Russell 2000 today specifically, which may be one of the reasons why we're seeing some of that strength showing in that little bit of a balance. But look at some of the companies that are within this particular space. These aren't the Metas, these aren't the NVIDIAs, these aren't the Apples of the world of the technology space. These are the Rigettis and the SMCIs and the TTMIs of the world that have been kind of enjoying that halo space in the AI build out, and will likely continue to see that halo build out of the space. And we take a look at some of these companies within this space, for instance. So here's Credo Technology, one that's been discussed on the Schwab Network on a couple of occasions. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. Rigetti, also in that same space, in the semi and semiconductor manufacturing equipment space. SMCI within the hardware space. And then we get into the software space over here with some of the others, with Mara and Wolf and a few others in this particular space. Small cap stocks, large halo around that AI space. So looking for strength as you build watch lists. If we were to take a look, I want to do a real quick comparison here. If we were to look at, say, for instance, the NASDAQ 100, and I'm going to kind of pop these up side by side. So I'm going to shift over here to the NASDAQ 100, and you can see where the strength is. It's in some of these big names, big cap names. Amazon, it's not in NVIDIA at the moment, maybe a little bit of space. But Amazon, Meta not seeing it, but Palantir, AppLovin, and others. You have some that are comparable market cap size, but kind of sit in this larger index. And if you break this down into some of those spaces, if we were to kind of take this to the information technology space, you can see where the strength is in, say, for instance, technology, hardware, storage, and peripherals. It's not there in the NASDAQ 100. It's the software space in the big names. It's semiconductors and semi-equipment in the big names. But then you pop down here to that, again, to the small caps, and you see where some of that space or that strength exists. So if you can identify strength in big indexes, meaning the big names, those leaders, the Mag 7s in the big indexes, and then you can rotate that into a watch list down here on the small spaces, kind of that halo effect, that has the potential to be a worthwhile watch list and looking at. Now, again, not a recommendation, not a guarantee of any kind of movement, but this gives maybe some additional opportunities or looks at some movement within that space. And so that's kind of how we can use a tool like this to kind of help us to see where there is potentially some strength. Now, her name was Lola, asks the question, were the Mag 7s once in the Russell 2000? And very likely, because, NVIDIA didn't come to market as a $5 trillion company. Apple didn't come to market as a $5 trillion company. And so, you think about what that suggests. And it suggests that as those companies were, these companies may someday become, right? And so that is as the potential. Is it a guarantee by any means? No. I mean, isn't that every investor's dream, to find the next XYZ stock, the next, not XYZ, YZX. We can't say XYZ anymore because that is an actual stock. But the next market leader, right? Low probability scenario, trying to find that diamond in the rough. What's a high probability scenario is that I'm going to read every comment that you guys make in that feedback survey, which Cameron just reposted out there in the chat. So low probability of finding the next diamond in the rough, high probability of opportunities that might exist within this space for other types of strategies. Yeah, you need a crystal ball to be able to do that. Okay, so PH Trader says, tracking in the desktop platform in a paper money account, see different leaders in both of these different heat maps. Is that normal? And it may very well be, depending on the time and depending on what is going on. So depending on what your delay is, if you're in a paper money version, mine is a paper money platform that is designed to look and act as if it were a live platform because it's a demonstration account that we use for instructing. So where it's pulling the feed to get this information in that time stream may be a little bit different than when it is pulling you in your platform is pulling that information for that feed. So that may be the difference. If you notice that there's a great disparity, you might look at what your timing is and maybe restart the platform. So see if there's maybe some kind of delay. Okay. All right. So now that we've got that, one last thing I wanted to do, since we're on the discussion of interest rates, I wanted to come back over here to the chart, and I wanted to do this. Now, I posted this earlier this week on my X profile, and it's just a really quick way to do a quick back of the napkin calculation about what the market expects or is pricing in for the next FOMC meeting. Okay. And that is this. What I'm going to do is I'm going to come over here and I'm going to go to /ZQ. Now, remember, the 30-day Fed funds futures rate, this is what is projecting kind of that expectation of what the Federal Reserve is going to do on that overnight bank rate, that overnight lending rate. And we can do a really quick kind of back of the napkin calculation to see what is predicted or what is projected as far as this market is concerned as to what the next rate cut or what the next projected rate will be. So what I'm going to do is let me grab my annotation tool and I'm going to show you how we do this real quick. For those of you that were not or did not watch my video, it's on my X feed. You can follow me on X at Ben Watson CS. You can follow Cameron on X at Cameron May CS. I also posted it on my LinkedIn feed as well. By the way, both Cameron and I now have the opportunity to post on LinkedIn. Many of you have found us over there. We'd love to have you follow us over there. We'd love to have you be a part of that conversation over on LinkedIn. I will let Cameron post those links to the LinkedIn profiles. Yeah, Jerry says, 63% chance of rate cut per the Chicago Board of Trade. CME also puts out their FedWatch tool and others. Here's a quick back of the napkin way to do this. So assuming that there is, that 100 is the baseline, we take 100 and we subtract from it this number right here. Whatever this Fed funds futures number is currently trading at. So we then take that and we go 96.12. Now, the really simple calculation here, and I get it, there's some differences, that we're not trying to calculate probabilities. We're just going to do this. We're going to take 100 minus the Fed funds futures price, gives us what that expected rate is for the next meeting. So 100 minus 96.12 is 3.88. Well, we were just, so if this is, let me grab my annotation really quickly, equals 3.88%. So we were just at an effective rate of 4.11 prior to the cut. So 4.11 minus 3.88 is 23. That's okay. So rounding it up, that's a 25% basis cut from 4.11 to 3.88. That's what we got. Now, projecting forward, this really hasn't started to change yet. Right now, the Fed funds futures are projecting 3.88. That's where we are. So right now, the Fed funds futures are projecting no rate cut in December. Does that make sense? So given the fact that the Fed funds futures number subtracted from 100 right now is projecting the same rate cut that we are currently at in that risk-free rate, that's a projection of zero rate cut. If we start to see this number go down, right? We start to see this number go down, that 3.88. That's then when the Fed funds futures are starting to lean towards the side of there being a rate cut for the December FOMC meeting. But they haven't started making that projection yet, or they haven't at least started leaning that way yet. So right now, the market is essentially pricing in no rate cut in December based on what Chairman Powell said after the FOMC meeting. So that's kind of where we are at this particular point. When that starts to change, so keep an eye on that. You can also do it easy, in an easy way by looking at the Fed funds or the FOMC FedWatch tool. A lot of different ways that you can go about doing that and calculating that. All right, but that was just kind of a quick way to do that. I wanted to show you that really quickly here since we were on the conversation and talking a little bit about it. Let's do a couple of things here really quick. Let's pop back over here let's close down. Whoops. I got to close that down. Let's close down our left-hand side. I want to pop back over here to our sector grid. And by the way, this sector grid that I have is posted in the description page to this particular webcast. I just want to see what has been happening with the sectors of the market in this particular case. So energy kind of flat, even though we've been seeing crude oil going up a little bit. We'll take a look at that in just a second. Basic materials, seen a little bit of a bounce. Again, these are the sector indexes, seen a little bit of a bounce here today in that basic material space. Industrials, continuing to gain some strength and seeing a little bit of a bounce. As a matter of fact, let's do this. Let's go through these real quick, and then we'll drop into these individual. Consumer discretionary, coming up to a high, and then maybe starting to pull back a little bit. Consumer staples, on the other hand, starting to reverse a little bit. We talked about that a couple of weeks ago, the significance of consumer staples maybe gaining some strength. Healthcare pulling back, but it's been on an uptrend. Financials rolling over. Now that the Fed rate cut is in, information technology still extending with that bull flag. Communication services extending with a bull flag. Utilities, on the other hand, pulling back just a little bit. Real estate back down on a support level. And overall, the SPX doing what we looked at before. So let's maximize each one of these. Energy up a little bit, but not breaking out of this sideways range that it's been in. Crude oil, I'm going to come back up over here to the flask icon. I'm going to type in comparison. Comparison. There it is. And we're going to compare this to /CL. And again, using the futures contract as a market measure, not a tradable instrument. Click on apply and OK. Crude oil starting to make maybe the right-hand side of this inverted head and shoulders, or what Pat Mullally and I used to call a phoenix pattern, which looks like a rising bird with very short wings here. The potential for this to move to the upside if we see crude oil kind of breaking out of this range above the $60.87 a barrel range or so, kind of in that area. But that's driving energy a little bit higher. We're starting to see the energy and oil services companies moving a little bit more strongly. Basic materials, which is also tied quite frankly to oil as well, but starting to see a little bit of bounce. And I would argue that perhaps we've got a little bit of this action going on. Maybe this diagonal downtrend line finding a little bit of a support there, and maybe making this into, if we click on redraw as a channel, kind of building into that downward channel that we're at the bottom of at this particular point. Now, starting to see industrials moving a little bit higher on the strength of some of the big industrial names, Caterpillar, Cummins Intermountain, or Cummins International moving a little bit higher here. I just want to say this. You remember we talked quite often about the halo effect of what gold had been doing? Gold going higher, dragging up some of those industrials, and at some point it was going to see some movement in those industrials. Not just the mining companies within the industrial space, but the Caterpillars of the world that makes mining equipment, the Cummins International that makes the engines for that mining equipment, eventually the Goodyear tires of the world that put the tires on those mining equipment products. So industrials seeing a little bit of strength here, potentially to move out of this channel. Again, they've been in a bit of a channel. They're up near the top of that channel, but they're reversing above the midpoint. If we were to draw that channel line, I'm going to grab the tool here down at the bottom. We're just going to draw that channel in a little bit like that, and we're going to draw that channel in a little bit like that. And you notice that it's staying up in that top edge, kind of testing that resistance area. So the potential to move higher there in industrials. Consumer discretionary, flipping back and forth here. We saw a pullback and then a rally. What we're going to start to get in the earnings season now, in this late portion of the earnings season, we're going to start to see some of the discretionaries, the apparel manufacturers, the retailers start to report, and that's going to be a better read on consumer discretionary and consumer spending, especially as we go into the holiday season. Now, here's the other thing to think about. In terms of all of these things, we don't have economic data coming from the government. This is all going on in the absence of. And so there's a little bit of a vacuum, which may create a little bit of this volatility. Consumer staples continuing to move to the downside. And we talked about this over the course of the last couple of weeks. There's been this shift in the last 2 weeks twice. And that first shift was consumer staples moving from below to above this support level, indicating maybe a shift into a risk off or more defensive posture on the part of investors. It has now shifted very much decidedly in the other direction in the last few days to a risk on perspective, consumer staples breaking below that support level again, kind of in that risk on perspective. When consumer staples are below this major support, kind of this midpoint support, that's suggestive that investment is going elsewhere. It's going into those risk on names. And that's where we get into things like healthcare, which is seeing a little bit of a continued space to the upside, as we've seen some of the also biopharmaceuticals within this space doing well, the Eli Lillys of the world. Financials finding a little bit of a support level here, but still under their moving average. Information technology, if you want to see the oppositional movement to what's going on over there in consumer staples. If, as a matter of fact, look, do this on your chart. Take that symbol that's on the chart and put a minus sign in front of it and flip it over, and you see, hey, look, that kind of looks like what was going on in consumer staples with that breakdown and then a little bit of a rally. Because all I did is I flipped the chart over, I just inverted it. But if you take, you got to remember, look, you got to remember to take that minus sign off so that you can see it right way up. But you can see that this is kind of that oppositional movement to those consumer staples, information technology seeing the strength, maybe a little bit of weakness up here at the top, along with those consumer staples kind of go in the other direction. Communication services, kind of the same thing, a little bit of a bull flag here as we get into the Netflix earnings, for instance. And that was a little bit of a disappointment, but then they announced this 10-for-1 split, and that kind of has an impact here as well. Popping over here to utilities, starting to fall off a little bit. Now the rumor has become the news, and utilities, again, in anticipation of not really projecting a rate cut into the December timeframe, that might be a challenge here for these utilities because they, in a lot of cases, live and die based on those interest rates because they have to bond for infrastructure build out. And then real estate. Mortgage applications, refi applications ticking up on the perception that rates are going down. So we're starting to see that pick up just a little bit here, maybe giving us a bit of a double bottom, but it is not quite there yet. It's got a ways to go to get out of that challenge. A couple of things that I want to talk about too before we go. Let's come back over here to our VIX grid and see what's going on. Volatility of VIX increasing. We're seeing a wide disparity between volatility of the VIX and the VIX. And remember I said, we've talked about this before. When you see that wide disparity in between volatility of the VIX and the VIX, that generally is an indication that there's activity going on both sides of the options market in terms of protection. So we had roughly a mixed day today. We had the VIX go up a little bit, but come right back down. We've had overall in the last couple of days an up, or over the course of the last week, an up week. An up week doesn't oftentimes correspond with an up VIX. But what that suggests is that maybe there is speculative option buying. And I'm not going to go into the speculations in terms of what that means, but I just wanted to illustrate this. That sometimes VIX gets expensive because there's buying on both sides, not just on the protective side. Does that make sense? Because it becomes cheaper when implied volatility has been relatively low to speculate using long positions as opposed to short positions. And that raises that VIX level kind of across the board. So something to pay attention to, and also a function of that move in the volatility of the VIX versus the VIX. When we see that disparity wide, it's often an indication of a reversal in the VIX and the VIX moving down a little bit. We saw it here, we saw it here, we saw it right here, we saw it right here, and it comes oftentimes after a big spike in the VIX, and then we tend to get that little bit of a bleed off. Let's come back over here to our single grid once again and take a look at a couple of things that I wanted to pay attention to. One thing to put on your just kind of market knowledge radar, NFLX has that split coming up. 10 for 1 was the announced split. And not at all unsurprising because, or not at all surprising because, you know, when we see stocks that are up in this $1,000 to $1,200 range or wherever, that tends to be some pretty rarefied air. The theory behind a stock split is not that the split has any kind of material change on the absolute value. It just means that the share price becomes a little bit more accessible for investors when it's not $1,200 a share. But the anatomy of a split is oftentimes there is a run-up prior to the split because people are buying in anticipation of. Let's see if we can put this out over the horizon. I'm going to see if we can add over the horizon 50 bars, and there it is. Here's the split date on 11/17 is the split date. So it's very likely, just given the anatomy of a stock split, that we'll see prices rise into that stock split date. Then there's oftentimes some selling, so we get what's called a post-split depression. And then the theory behind the split is that then the shares continue to go on to reach these same prices once again. It may take a while, but there's likely to be some buying in anticipation of. Now, it is Halloween, and as is my tradition, I like to leave you with stocks of the day that are based on the activities of the day. And so it is Halloween, and we know that that's bringing trick-or-treaters and a variety of other things. So what I wanted to do was I wanted to come over here. I used one of my grids. I used my burger stock grid, but we're not talking burgers today. We're talking spooky Halloween stocks. So we're going to start this grid with Hershey's, because you got to give out candy. We've been suffering from high cocoa prices as well as high sugar Halloween, but there you go. There's Hershey's pulling back a little bit. Walmart, which is one of the larger retailers, of Halloween paraphernalia. At least here in Utah, Halloween is an enormous decorating event. But Walmart's been pulling back a little bit. Mondelez, which is a food distributor and producer, they own the Oreo brand as well as others, seeing a little bit of a gap down and rally today post the earnings announcement. Now, Jack, which is Jack in the Box, is not necessarily a Halloween stock unless you consider the impact of a 3-pack of mini tacos from a Jack in the Box to be as spooky as I do, having been there before. But it's in the name. I didn't have a jack-o'-lantern stock, but I've got a Jack stock. And then we've got Tootsie Roll, which is kind of mirroring what Hershey's is doing. And then I wanted to come over here and leave you with this. As this a win of Disney and the Haunted Mansion. By the way, speaking of that, we're going to be in Anaheim in November for our Market Drive event. We'd love to see you all there. I will be there. I will be going to the Haunted Mansion. You're welcome to join me if you want to come over to Disneyland. We're going to be there at the Haunted Mansion. That is not a recommendation by any means. But what I now want to say is simply this. My thanks to Cameron Mayen, and my thanks to all of you and everybody else for being here and joining me. But now we find ourselves at the end of this journey today, and there are no doors and no windows in this webcast, which leaves you with this chilling challenge to find a way out. Have a great Halloween, everyone, and we will see you next week with our whole series of webcasts. Take care, everybody. Bye-bye.